Reinsurers in recent years have faced challenges in meeting their cost of capital, testing investors' risk appetites. But according to a new AM Best report, 2023 was an about face. Here to discuss the report, as part of AM Best's annual look at the global reinsurance industry, is Sridhar Manyem, Senior Director, and Helen Andersen, Industry Analyst, both of AM Best's industry research and analytics areas. Sridhar and Helen, great to see you. Thank you so much for joining us.
Thanks, Laurie.
Thanks for having us.
Helen, how did reinsurers fare in 2023 on meeting or exceeding their cost of capital?
Overall, reinsurers actually exceeded their cost of capital in 2023, thanks to both positive underwriting results and also recouping unrealized investment losses from previous years, thanks to higher reinvestment rates.
Helen, insured loss years totaling $100 billion or more is becoming more commonplace. How can companies mitigate this to meet return expectations?
Well, one thing that they are doing is raising rates, though rate increases are slowing down. And other things that they're doing are implementing these really thorough de-risking measures on their portfolios, including tightening terms and conditions, and also really sharply increasing attachment points, so more of the impact of these high loss events are retained by primary insurers.
Sridhar, you introduced a new metric to calculate cost of capital. Can you tell us more about that?
Yeah, sure. So the classic way of calculating cost of capital is something called the capital asset pricing model. So it's a widely known way of calculating the return expectations for a company. And it essentially has a number of assumptions. Investors are have a diversified portfolio, and they can diversify idiosyncratic risk away, and the market pays them only for the systematic risk that they take. It has a certain number of flaws, especially when it comes to the insurance industry, because insurance industry they have catastrophe risk, which technically doesn't correlate with the markets. How can you diversify that, so on and so forth? So there's a little bit of difficulty in terms of using CAPM in order to calculate cost of capital, but it's still widely used. It's a good measure in terms of comparing year over year or comparing across the industry. So we've used it this year as well. But in addition to in addition to the CAPM, we introduced another a way to calculate cost of capital called the market-derived capital pricing model. And what that does is it uses an individual stock's volatility, price expectation, cost of options, and uses that to calculate what should be a minimum return expectation for an investor investing in this particular company. So we think it's more company specific and calculates the company's intrinsic volatility and gives a slightly more conservative measure. So if you look at the results from the MCPM, that we call it, market-derived capital pricing model, it's higher than the cost of capital that's calculated by CAPM.
Sridhar, can reinsurers effectively drive their own cost of capital results via reducing their risk appetite, or would that create a competitive disadvantage?
Yeah, I think if you look at cost of capital, whatever method you calculate, the value of any financial asset is the present value of future cash flows, right? So there are two aspects to that. One is prospective, which is what are the cash flow expectations from this company, right? And those cash flow expectations, those cash flows are generated through good underwriting, good investment, a mixture of prudence, and at the same time taking a risk at the right time, when to be risk on, when to be risk off, when it comes to underwriting or investment. So there's a prospective expectation set for cash flows. And then the second aspect is, how are you going to get these cash flows back to present, right? So that's essentially, how are you discounting these cash flows back to the present value, right? And that's essentially the riskiness, that reflects the riskiness of a company. the more uncertain the cash flows are, the higher the discount rate that you use. So to the extent a company can control that riskiness and at the same time take a balanced approach to generating good underwriting results and investment results, it's possible to calculate the cost of capital. And the last thing I would say is, as long as investors know the risk that the company is taking, the more articulate you can be about what risk your a reinsurer is taking, the more transparent you are. The investor knows what they are getting into in terms of risk. What is the relative level of risk I'm taking by investing in a particular reinsurer, right? So that's how probably you can control the expectations of investors.
So, Helen, can reinsurers repeat this result next year?
Well, of course, it depends on the rest of the cat year. Now, reinsurers' ROEs this year were pretty exceptional, and we expect it to moderate somewhat. But based on the trends as we see them with higher prices and higher attachment points, we do expect reinsurers will probably meet their cost of capital next year.
Helen, Sridhar, thank you both so much for joining us. Always a pleasure.
Thanks, Laurie.
Thanks, Laurie.
That was Sridhar Manyem, Senior Director, and Helen Andersen, Industry Analyst, both of AM Best Industry Research and Analytics team. For AM Best TV, I'm Laurie Chortis.